maybe we can start actually with the point you closed on about uncertainty, which is the big question that's facing anybody who's trying to forecast what is likely to happen as a result of this coronavirus crisis. And every business and sector is confronting this problem. So I wanted to start by asking all of you how your assumptions have changed since the start of this crisis. So I guess, pretty much everybody started out maybe with the view that this was going to be, in terms of 2020, a tale of two halves, that we're going to have this huge shock and huge contraction in the first half of 2020, and then we were going to see, inevitably, given the size of the contraction in Q2, a big rebound, at least in quarter-on-quarter terms, in Q3, and then a gradual recovery. So, to what extent, have you revised your assumptions from the start? How's that affected your forecast, and how do you think that the banking sector is doing much strategizing and kind of more long-term thinking at the moment, or has it all been so far about reacting to the shock? I think a few of you raised this, particularly Mr. Vamvakidis in his introductory remarks, that this is the big uncertainty, and actually we could be living with this for a long time. A vaccine's not arriving anytime soon, and even if it does, is that going to be effective? So that's my first question, really. Could it be that actually we're likely to see much more far-reaching changes in the sector, and much more damage maybe than people anticipated at the beginning? So maybe I'll come back to you, Mr. Vamvakidis, since you raised this as well. What are your thoughts now?
More bearish actually than the consensus on the recovery. We have seen some strong data recently, but this is just because of base effects exiting from the shutdown of the global economy. It is the first time we put a large share of the global economy in an induced coma, and as you move away from to see a temporary improvement in the data. However, the question is, can we really go back to pre-crisis levels of production if the threat of the virus remains? And the answer is negative. As long as the health crisis continues, many sectors cannot really go back to operating at full capacity. And we just don't know when we will be able to put the virus behind us. We don't know how sectors need to adjust to a more is still there. And as I said earlier, as long as the real economy remains weak, if we are in an equilibrium in which output but stabilized in a weak level, kind of like on an L-shaped of recovery, with any loosening of measures, bringing back infections, so keeping economies operating below capacity, this is not a positive scenario for most sectors, including for the banking sector. And in addition, although monetary policies are supportive in this case for nominal assets, for financial assets, for money, they limit how much actually this rally can support economy. And low interest rates forever is not a good thing for the banking industry. So this uncertainty is actually a tremendous problem, and I'm concerned that the risk rally we have seen, to a large extent because of the massive policy support, might some complacency because the real economy is still suffering.
Thank you. Yeah, I'll ask you in the order in which you spoke. So, James Longsdon.
Yeah. So we have forecast-wise, yes. If I look at I guess when we're doing most of the forecast for how we think banks will perform, we do pin a lot of our forecasting on our economics team's colleagues' forecasts for important factors like GDP development and unemployment, house prices, those sorts of things. This year, I think, has been highly unusual. We entered the year, for example, expecting the Eurozone to grow by about 1% this year, and we're now at -8% this year. And I think we've revised our forecast something like 4 or 5 times, probably, from about middle of March onwards. So, yeah, unprecedented level of revisions to our forecast, really, as we grappled with what I think our economists call lockdown economics, which the economics of lockdown and what that means. So that's been pretty significant level of revisions. You asked a question, I think, about banks. Are they in a strategy or coping phase? I think banks are very much hitherto, really up until around about, have really been dealing with just the near-term implications of the pandemic, going from the mundane or the operational side very on about working from home and branches and head office working from home, etc., that sort of thing, and how to deal with recording telephone calls if you didn't comply with MiFID, that sort of thing. I think they're now at a stage where they're starting to look a little bit more beyond that, but I wouldn't say the sort of strategy-wise, I'm expecting we're seeing any voices of sort of absolutely transformational strategies going to come out of this. I do see more a sort of an acceleration of themes that are already there. So the classic digitization, yes, this is probably a catalyst to make this happen faster. Yes, they've been needing to cut costs. They're realizing that interest rates are here, lower for longer. Costs will probably have to be cut more. They'll probably have to cut them a little bit faster and a little bit harder, but they won't need as much real estate, I suspect. So I think it's probably, strategy-wise, it's more of a catalyst to accelerate themes that are already there. I think we could see more M&A, but I don't think revolutionary strategy changes are going to come out of this. Really, it's what was already there done quicker.
Thank you. Guido, do you want to comment on this?
Yes, thank you, Jean. We need a considerable number of European firms are likely to reach excessive levels of financial leverage as the crisis unfolds. And as a consequence, a large share of EU firms could start the recovery period with the leveraging pressure. This, in turn, would have negative consequences on these company abilities to carry out investment plans. And lower investment would reduce demand and therefore also reduce revenues, which is another adverse feedback loop. Liquidity shortfall and much lower net revenues resulting from a period of exceptionally low activity will sure impair corporates' capacity to service their loans and therefore result in increase in NPLs. And on the financial system, too elevated NPL ratios could trigger a repricing of funding conditions of bank. Anyway, this time, and this also was said before by other speakers, systemic risk should be more contained than at the occasion of the previous financial crisis.
Thank you. Julien, do you agree with James's point that this crisis is more likely to be an accelerant than an accelerator of pre-existing trends rather than something that is going to usher in something completely new?
I agree indeed, especially short term versus long term. The banks have reacted to the crisis and they have reacted well, in my opinion, very well, and it forced the pace of this digitization. Still, it's all. I think the thinking about the longer term is now coming to people's mind and say, okay, the world is changing. Not only is changing, but by definition, by nature, uncertainty cannot be predicted. Okay. And that's the hard thing. So I usually tend to say, the best way to predict the future is to create it. So it could lead to some new value propositions, new positions, enabled by either the new behaviors or even technologies, because we haven't talked about technologies, but some technologies are now mature. about artificial intelligence, or if you look at technologies such as blockchain, and you've got the central bank digital currencies coming in, etc. So maybe it'll be a trigger for something new coming in, and people will create new things. So I think it's a mix. I fully agree it's reactive and improving the pace of digitization, but it could open up some new things. And if you look at the last crisis, it created some of the big leaders of today. If you look at Uber or Airbnb and these kind of players, they actually were built in the previous crisis. So we'll see. And again, the best way to predict the future is to build it.
Thanks. So a few questions have come in on our channel, and one of which is, are we heading for a sovereign debt crisis? Not this year, maybe, but further down the line. And what about this question of the so-called doom loop, this interconnection between sovereign risk and banking sector risk? Is that a bigger problem now, perhaps, than it was in 2010, or less of a problem? Anybody like to comment on that?
Yeah, I'll pick
Maybe
up on that one.
Okay, let's start with Mr. Vamvakidis and James.
Yeah, I mean, the fact is that as a result of the COVID-19 crisis, every single will end up with much higher debt levels. In the case of the Eurozone periphery, we are starting with already high debt levels. And if we take the ECB forecasts, Italy will reach 160%, in Greece 200% of GDP, Italy, Spain about 130% of GDP. These are huge debt levels. Now, the real bazooka in this crisis in Europe has been the ECB's PEP program, which has allowed the ECB to the capital. But this is next year or at some point after the pandemic to end, and at that point, it has to go back to the capital key. So there is the question, what happens to the periphery spreads after the PEP program ends and the ECB cannot continue supporting the periphery because of the capital key? How can the periphery reduce the debt levels from much higher ratios than before this crisis? Use them to pre-crisis levels. We're going to need massive austerity, not 1 or 2 years. We're about 10 years of austerity measures, which politically is impossible. And in any case, the fiscal rules, which now have been suspending, will kick in. So I'm not saying we're about to have a sovereign crisis, but all these questions, I think, will be very much relevant for markets after we end up dealing with the pandemic.
Thanks, James.
Yeah, I'm not a sovereign analyst. So I'll leave the sovereign angle, direct sovereign angle, to one side. But I will pick up on the sort of sovereign bank nexus, because obviously I look after bank ratings, so I do care about that sort of thing. We do think that the sovereign bank nexus, as I said a little bit earlier, is very real and exists and hasn't been broken. In rating terms, I don't think we rate any bank in Europe above its sovereign of domicile unless it's owned by a stronger foreign shareholder. Then that can be rated above the sovereign. But banks rated on their own merits, if you like, their own financial strength. We don't rate any of them above their own sovereign domicile, and that largely reflects the fact that obviously the huge exposure they have to the local economy, just by lending into it, but also their large holdings of sovereign debt. It does vary, but still quite large holdings of sovereign debt. And there's quite a lot of academic literature that suggests that there's a sort of positive correlation between sovereign risks rising and bank holdings of debt rising. So as the sovereign gets weaker, banks tend to have taking on more sovereign debt as their risk-free asset. So that's direct link, which obviously can lead to solvency, correlation between the solvency risk of a bank and sovereign indebtedness. But also there's the liability side of the balance sheet. I think people forget that when sovereign risk premia increase, it tends to feed very directly through into bank funding costs. In an extremely extreme situation, it can feed even into sort of deposit stability and things like that as well. So we do still see that link as very real. And clearly, if there were sovereign risk off situations, it would feed through into the valuation of securities on their balance sheets. So there's accounting rules that can help there, but it clearly affects the value of that, and it affects their sort of liability side funding access and costs as well. So yeah, we think it's real, still hasn't been broken.
Thank you very much. I don't know if you wanted to comment very quickly, Guido, about the situation in the Western Balkans apropos this question, where obviously in many places, maybe say the biggest country in the region, Serbia, the public debt to GDP ratio is much lower, and has actually come down substantially in recent years to about 53, 54% of GDP, but is now likely to rise about 10 percentage points this year as a result of the hit to the economy and to the public finances from the pandemic. Do you see any issues here in terms of financing for these peripheral economies?
Yes, Joanna, I think for us, sovereign debt in the Western Balkans is indeed a reason of concern. We are very much focused to preserve capacity of countries to take and use their debt in a very useful way. To this regard, I have to say that our recent operations are very much based on the utilization of external mandate, which is a guarantee provided by the European Commission to support public sector, particularly public sector projects in this country. So, I mean, we are very we think that generally finance provided by European Investment Bank is indeed and it is it for the long-term development of these countries. You mentioned Serbia, which is going through a very important development phase, but also the other in the other Western Balkans, very much the necessity to guarantee that long-term investment will have a real impact on the economy and on the life of the citizen. Generally, for us, as the European Commission bank, we want to let these countries understand the importance to be closer to the European Union, and which are building bridges, building motorways, which are the steps that could be taken to discuss an enlargement process and an integration with the European Union.
Okay, thank you. Thank you very much. Now, thank you very much, all of you from the panel. Thank you for your introductory remarks, for your answering all those questions. We've come to the end of this session. So thank you again for joining us today. And we're going to disconnect now because we're going to have a short break, a 10-minute break, and we're going to restart the discussions in 10 minutes. Thank you very much indeed, and have a good day. Bye.
Thanks. Bye-bye.
Bye.